In today's video, I'll be comparing stocks against ETFs. Which one is best for you and will ultimately make you the most money? I'll be comparing the pros and cons of these two types of investments so that you can make an informed decision on which one is the best for you. Picking the right investment can be difficult. You don't want to miss out and pass up an opportunity to make money, and at the same time, you don't want to make a bad investment that might ultimately not be as profitable or even worse, cause you to lose money. If you find the video helpful, make sure to drop a like for the YouTube algorithm and subscribe to the channel so you can stay updated with future content. Keep in mind, this video is just my opinion. I'm not a licensed financial advisor, and take everything I say in this video with a very large grain of salt. To understand whether or not stocks or ETFs are better, we'll break down each one, starting with ETFs. ETFs are exchange traded funds. It's essentially an investment product that's made up of multiple other companies, and the companies that comprise an ETF are related to the particular goal that the ETF might have. For example, there are ETFs that track a specific sector in the market, such as the ARK Genomic Revolution ETF, comprised of exclusively new and perceived to be revolutionary healthcare companies. And then you can also have an ETF that will track the overall performance of a company's stock market. With ETFs, it also can be quite appealing that you don't have to spend any time researching a business because your money is spread out amongst multiple companies. This is particularly true when you're looking at something like the S&P 500, where all your money is automatically distributed amongst the biggest 500 American companies in the world, because it will be in giants like Facebook, Google, Tesla, Amazon, all of these big branded companies that have stood the test of time and routinely grow year after year and maintain their position as some of the biggest businesses in the world. For example, looking at America, there is the S&P 500 Vanguard ETF. Its sole purpose is to track the S&P 500 index, which again is just the biggest 500 companies in America, and the sole purpose of this ETF is to mimic the performance of the S&P 500. So it will buy all the same companies as the S&P 500, and therefore when you put the two stock graphs side by side for these two investments, they will have an identical performance. Overall, with an ETF, you have a very diversified investment. This can be both a good and a bad thing, because overall your money will most likely routinely grow, assuming that the overall strength of the companies that make up the ETF are quite strong and will be profitable. Again, with this, they don't normally grow at a very fast rate, but this again can vary based on the ETF that you're wanting to invest into. For example, comparing the overall performance of the Vanguard S&P 500 ETF, the one related to tracking the top 500 biggest companies in America, you can see that it's gone up roughly just over 100% in the past 5 years, in comparison to the ARK Innovation ETF that has gone up over 440% since it came out in late 2016. And this is again because of the types of companies that are part of the ETF. With ARK Innovation, it has companies like Square, Tesla, and Roku, believed to be newer, innovative companies that have a lot of future potential, and therefore they grow at a faster rate, but are overall believed to be a less consistent investment because the companies that make up that ETF are not as established yet. With ETF, much like stocks, there can also be a dividend payout when a percentage of a company's profits are paid back to its investors in the form of a dividend. People do quite like the idea of making passive income from the ETFs giving them a dividend payout, but you do need to keep in mind that you can get caught in a dividend trap when you only look at a company that has a high dividend yield that is paid back regularly, despite the company not actually being able to afford this, and this in turn can cause you to lose money because you might be getting a nice consistent dividend return, but the overall stock price of that business might be declining in value. So that's something to keep in mind. Just because an ETF or a stock as well is giving you a high dividend return, you need to make sure that the company is financially healthy and financially strong and can actually afford to pay this out to you, because overall it can be a bit better if a company holds on to its dividends and reinvests it into the company to grow the business, because the more the business grows, the more the stock price increases and the more money that you make from your investment. Moving on to stocks, these are essentially a single unit of ownership in a company that can be purchased, and when someone buys a portion of a company or a share of a company, they become a shareholder. They provide their money to that business with the belief that the company will be able to use the money effectively to grow, and therefore as the company grows, so does the stock price and the amount of money that can be generated for the investor. Typically with stocks, the perceived value or the perceived profit that you can make is a lot higher in comparison to an ETF. It's more or less a risk versus reward, because with an ETF your money is diversified amongst multiple companies, as opposed to stocks where all your money is tied just to one business. If that business is doing poorly, then so will your investment. Also with stocks, there is a lot of upfront time and effort that the investor will have to put up in order to research a company and determine whether or not that company will be worthwhile holding on to and will actually be a good investment for any period of time, say 5, 10, 20 years into the future. If you don't spend the right amount of time and effort researching a company, then more likely than not you will lose money on your investment. And this is where a lot of the bigger investors like Warren Buffett will urge the majority of people to just invest in ETFs, because most people don't have the discipline and emotional control to effectively invest into individual companies. More often than not, people might just invest on hype and speculation and just follow the herd and buy what other people are, without actually knowing if that investment will be worthwhile or if it might just be something that's purely fueled by hype. Don't get me wrong, individual companies can make outstanding returns just looking at Tesla, but these can be few and far between, and actually picking the right company is no easy feat and does require a fair amount of effort from the investor's part to actually know what they're buying, to understand the cash flows, the management, the future potential problems for that business that might negatively affect its growth. And these are all factors that you have to keep in mind when you're making an investment into an individual company. Overall, when you compare stocks and ETFs, I'd say having a good balance between the two is the best thing for your portfolio. Having all of your money exclusively in stocks does put you at risk, especially if you're a beginner and haven't necessarily put too much time or effort into selecting which stocks you're buying. So having a combination of ETFs with stocks gives you a balance between security and diversification, but also lets you make some of those massive gains that can come with individual stock selection. I'd say when you're first starting out, you want to have most of your money in ETFs like the S&P 500, which is believed to be one of the most tried and true investments that you can make, and then potentially branching out into some individual blue chip companies like Apple, Facebook or Microsoft, and keeping in mind that the longer the company's been around and the bigger it is, the slower it will grow. The newer and smaller the business, the greater its growth potential, and therefore the greater potential profit that you can make from it. Now that you're familiar with stocks and ETFs and know which one is best for you, you might want to know about some common investing mistakes that are relatable both to stocks and ETFs. Check this video out on screen to give you my top 7 investing mistakes. These are the things that I wish I knew when I first started investing, and it would have saved me a ton of time and money. Check that video out so you can avoid some of the mistakes that I went through when I first started.